Welcome back to FH. In the video today, I want to talk about what it means to debit and credit in accounting, so stay tuned. Now, what does it mean to debit and credit in bookkeeping and accounting? Debit and credit are simply the tools or terms we use to post or describe what happens to particular accounts as a result of a transaction that has taken place and we are about to record. To debit an asset or expense account means we are increasing the funds or balance in those accounts, while to debit a liability or equity account means to reduce the funds or balance in that account. Now, you might wonder, why does a debit in one account mean something entirely different from the same debit in another type of account? Well, the tools of debit and credit adjust their functions or mode of operation based on the nature and classification of accounts they are dealing with. Now, what are the various classifications of accounts and how do they behave and how do they affect the tools of debit and credit? Now, there are 5 major classifications of accounts that make up the foundation of the company's financial statement. They are assets, liabilities, equity, that is capital, revenue, that is income, and expenses. Now, assets are resources owned by a business that have economic value. Examples are cash, inventory, property, account receivables, which are otherwise called debtors, and equipment. Examples are plants and machinery, motor vehicles. Now, liabilities, on the other hand, are financial obligations or debts that a business owes to others. Examples are loans, account payables, otherwise called creditors, short-term loans, and long-term loans. Equity simply refers to the total funds the owner of a business invested, or the claims on the assets after all liabilities have been paid. Examples are capital, retained earnings, or stockholders' equity in a company that has shareholders. Now, revenue. Revenue refers to the money earned from the normal business operations, such as the sales of goods and services. Examples are sales revenue, income, which is profit, which is what you arrive at after deducting cost of production or operation from sales. Now, expenses, on the other hand, refers to costs incurred by a business in the process of earning revenue. Examples are salaries, rent, equity, or depreciation. Now, these are the classifications, and debit and credit means different things in these accounts. This is a principle you need to master. Now, how do all this tie together and work together? Now, the guiding principle is as follows. All asset accounts are debit entry accounts, which means that the side of increase is on the debit side of your T account, while the side of decrease is on the credit side of your T account. This simply implies that to increase the balance in that account, you post to the debit side of your T account, while to decrease, you post to the credit side of the T account. Now, this is what a regular T account looks like. So this is the traditional T account before people started using accounting software. And it clearly shows the debit and the credit side. That's the asset account. That's the liability account. This is the equity and revenue account, showing the debit and credit side for both accounts. And this is the expenses, showing the debit and the credit side. So this is a regular traditional T account. While if you're using an accounting software to post instead of the traditional T account, and you want to increase funds or balance in an asset account using your software, you post to the debit side. While if you want to reduce the balance of funds in that account, you click credit on your accounting software. On the other hand, all liabilities accounts are credit entry accounts, which means that the side of increase is on the credit side of your T account, while the side of decrease is on the debit side. This simply implies that to increase the balance in that account, you post to the credit side of your T account, while to decrease, you post to the debit side of your T account. While if you're using your accounting software to post, and you want to increase funds or balance in any liability account using your software, you simply click credit, while to reduce the funds in that account, you simply click debit. Now, you would have noticed the terminology debit entry and credit entry. Now, the entry word beside debit and credit simply means that the side of entry into that account, which is a debit entry account, is on the debit side, meaning that's the side of increase. While the credit entry terminology simply means that the side of entry into that credit entry account is on the credit side, meaning the side of increase is on the credit side. So just master that, it's pretty easy. Let's go on with the other classification. You will have a better understanding now as I've just described what debit entry and credit entry terminologies mean. So, equity. Now, this is a credit entry account. Just like liabilities, this also means that the side of increase is on the credit side of your T account, while the side of decrease is on the debit side. This implies that to increase the balance in that account, you post the credit side of your T account, while to decrease, you post the debit side of your T account. While if you're using an accounting software to post, to increase the funds or balance in that equity account using your accounting software, you simply click credit, while to reduce the balance in that account, you simply click debit. Now, the next classification is a revenue account. This behaves exactly like your liability and capital classifications, as it is also a credit entry account. It means that the side of increase is on the credit side of your T account, while the side of decrease is on the debit side. This simply implies that to increase the balance in any revenue account, you post to the credit side of your T account, while to decrease, you post to the debit side of that T account. While if you're using your accounting software to post, and you want to increase the funds or balance in your revenue account using your software, you simply click credit, while to reduce the funds in that account, you simply click debit. Lastly, we have the expense classification. This behaves exactly like your asset classification. That is, it is a debit entry account. It means that the side of increase is on the debit side of your T account, while the side of decrease is on the credit side. This simply means that if you want to increase the balance in that account, you post to the debit side of your T account, while if you want to decrease the balance on that account, you post to the credit side of your T account. While if you're using an accounting software to post and you want to increase the balance in that account, all you have to do is just click debit. And if you want to reduce the balance in that account, all you have to do is just click credit. Now, here is a summary of all the classifications and how they interact with the debit and credit tool. Go through 3 practice questions to illustrate everything that has been discussed so far. So the first question is, a company purchases equipment for $5,000 in cash. How should this transaction be recorded using the debit and credit principle, specifically for assets? Now, the first step is you need to understand the accounts involved in this transaction illustrated here. You can see it's clearly highlighted and which should pop out in every transaction. You can clearly see equipment and cash. Now, from all we have gone through so far, we know that equipment is an asset. And we know all assets are debit entry accounts, meaning that the point of entry is on the debit side. So if you need to increase the balance of your equipment account, you need to post to your debit side. So that's the first thing you need to understand. Now let's go to cash. Cash is also an asset account. And we know, like I said, all asset accounts are debit entry accounts. And so the point of entry is on the debit side, like I said earlier. And so if you need to increase your cash, you need to post to the debit side. But if you're reducing your cash, then you post to the credit side. Now, step 2, let's apply the debit and credit rules. The company has purchased equipment, that is, assets in the company has increased. So the equipment account will be debited. And we know that the company is paying cash, and so cash is leaving the company, and so cash is reducing. So cash as an asset, the balance will reduce. And to reduce the balance in a cash account, which is an asset account, which makes it a debit entry account, we need to post to the credit side. Now, this is a summary of what the transaction will look like in a traditional T account. Now, let's move along to the next question. Now, the next question. A company takes out a loan of $10,000 from a bank and immediately deposits the amount into its business bank account. How should this transaction be recorded? Now, step one, like I said, identify the accounts involved in the transaction. What sticks out to you? Loan. The company has taken a loan. What did the company do with the loan? It paid it into its company's bank account. So the two major accounts that stick out in the transaction is loan and bank. Now, the next question is, what is loan? What kind of an account is it? It is a liability account. A liability account is a credit entry account. So the point of entry into a liability account is on the creditor. Now, cash, which is the same thing as your bank. What kind of an account is it? It is an asset account. And we know all assets are debit entry accounts, meaning the point of entry is on the debit side. And so if you need to increase your asset, you need to post to the debit side of your T account. And if you're reducing your cash, which is your asset, you need to post to the credit side of your T account. Now let's move to step two. In step two, we will apply the debit and credit rules. One, the company receives cash. That means that cash is increasing, asset is increasing. So that means the cash account will be debited. The second leg is the company now owes money because of the loan. And so the loan account is also increasing. And we know that when a loan account increases, liabilities are increasing. And we know that liability is a credit balance account. And so that loan account will be credited because the point of entry in a credit entry account is on the credit side. Now, this is a summary of what the T account will look like with the transactions posted. Now, let's move along to the third question. The third question. A company makes a sale of $2,000 worth of goods and receives cash immediately. The company also incurs an expense of $500 for delivery paid with cash. How should this transaction be recorded? Now, taking a look at this transaction, you will notice that three accounts stick out: sale, cash, and expenses. Those are the three accounts that stick out. The next step is to understand how these accounts behave. What are their classification? Cash is an asset account. An asset account is a debit entry account. And for a debit entry account, the point of increment and entry is on the debit side. Now, the company also incurs a delivery cost, which is the expense. And we know that expenses are debit entry accounts. And so the point of entry and increment is also on the debit side. But note that there's a third leg. And the third leg is that the delivery cost was paid for in cash. So the cash account is also affected. And so money is leaving the company as a result of the payment for the expenses. And so cash is reducing. And we know cash is an asset. An asset is a debit entry account, and the point of entry is on the debit side, while the point of exit and reduction is on the credit side. So we need to credit our cash account for this delivery expense. Now, putting all this together, this is what the T account will look like. Three accounts are affected: cash, sales, and delivery expense. We're debiting cash with $2,000 for the sales that we made and we received cash for, and we automatically go and credit the sales account for the sales that we have made to show that the sales in the company has increased. We're crediting the sales account because sales is a credit entry account. That is the point of entry. The point of increment in the sales account is on the credit side. While the delivery expense is also debited. It's debited because the expenses in the company has increased by $500. And we know that expenses account is a debit entry account, meaning the point of entry is on the debit side. And so we need to record the $500 on the debit side while we credit cash with $500. Now, this might seem so complex, but the more you practice this principle, the more it becomes a part of you. It's just a thought process. Identify the accounts involved in the transaction. That's the first step. Ask yourself, what classification of accounts do they fall under? That's the second step. The third step is to ask yourself, how do those classifications behave in terms of the debit and credit principle? Are they debit entry accounts like the asset and the expenses? Or are they credit entry accounts like the liability and the equity? If they are debit entry accounts, the point of increase is on the debit side. And that automatically means the point of reduction is on the credit side. If they're credit entry account, it simply means the point of entry and increment is on the credit side. And that automatically means the point of reduction and exit is on the debit side. So it's pretty easy. Just constant practice, and then it becomes a part of you. Now, this forms the foundation of the principle that every accountant lives by, which says that for every debit entry, there's always a corresponding credit entry. Thank you so much for watching the video, and stay tuned for the next video.